Elon Musk confirms that unsupervised FSD is already being used internally at Tesla, and it should launch later this year. Take a listen to what Elon Musk just said.
Tesla full self-driving unsupervised. I think we mentioned we're going to be, well, we actually are doing trials of that for Tesla employees already, and we expect to have that in commercial service sometime this year, which I mentioned at the last earnings call.
Now that was big news from Elon Musk ahead of Tesla earnings. That is essentially reiterating Tesla's previous guidance. Yes, Elon was pretty opaque, not really giving a date, just saying sometime this year that it will launch, but that's what Wall Street is looking for coming on January 26th when Tesla reports earnings. Now, considering the stock has fallen about $100 per share from $488 down to $392, this confirmation could be a good opportunity since we have a little bit better of an understanding of what we're going to get on Tesla's earnings call. And judging off of what Elon Musk just said, we're probably not going to be shocked or negatively surprised by developments. That's what Wall Street does not want to see for Tesla. They do not want to see Elon Musk walk back some of the timelines for robotaxis, and it looks like Elon has no plans in doing that. That could mean that maybe people got a little bit too negative on Tesla over the past 3 weeks or so. And again, I mean, Elon Musk just confirmed that they're already running unsupervised FSD trials with employees. That's huge. And Wall Street today just, I guess, did not pay attention to that. It did not get picked up on the algorithms or something. But you, my friend, if you're watching this video, you have a heads up before Wall Street. I guess this throws out the efficient market hypothesis where some people believe that asset prices reflect all available information. A direct implication is that it is impossible to, quote, beat the market consistently on a risk-adjusted basis, since market prices should only react to new information. And yeah, well, apparently this is not true because Wall Street didn't figure this one out. Tesla and Elon Musk today officially filed their appeal with Delaware's Supreme Court after a state judge rejected his $56 billion compensation package for the second time. And this is going to be caught up in the courts for probably at least another 6 months or so, but eventually it seems likely that the Supreme Court in Delaware will approve Elon's comp package. I believe this is a positive catalyst that will come sometime later this year. In other news, Tesla's Model Y is Sweden's most popular vehicle for the second year in a row. So much for the Swedish IF metal strike against Tesla. Doesn't seem to be doing anything. Bloomberg is reporting today that Tesla could collect more than $1 billion in compensation from rival automakers that need help meeting tougher pollution standards in the European Union this year, which this $1 billion or so normally gets excluded out of Tesla's auto gross margins and margins in general. It's not something Wall Street tends to look at too much, but it's 100% profitability to Tesla's bottom line. So this could help boost Tesla's EPS in 2025. The non-Foundation Series $79,990 all-wheel drive Cybertruck and the non-Foundation Series $99,990 Cyber Beast are now on Tesla's online inventory in the US, allowing buyers in select markets to take delivery immediately. Previously, only the $100,000 to $120,000 Foundation Series Cybertrucks were available in inventory. Now, we have some other important news today, not just Tesla specific, including some remarks from the Fed and what Nick Timmerhouse just said that is moving our markets. But we do need to cover some more important Tesla news as well afterwards, like the option activity, the short positioning, and much more. As you can see today, the VIX is up 3% to 18.36. The Russell 2000 is getting absolutely obliterated today, down 1.2% versus the Nasdaq down 1/3%, the S&P down 1/10%, and the Dow only down 0.07%. Small caps are just getting destroyed. It's kind of a weird situation overall, so there's a couple different pieces of news that I will share with you now. It was reported earlier this morning that Trump could declare a national economic emergency to justify universal tariffs. This is according to cited sources familiar with the matter that are unnamed from CNN. It says a final decision has not yet been made, and Trump's team is also evaluating alternative legal opinion options for implementing the taxes on imports. We also had a secret meeting with the ILA union and port owners overnight last night. This really is in regards to the automation disagreement that they are having with a port strike that could be looming towards the end of this month. And this new port strike would start on January 15th if these issues are not resolved, and that is 7 days away from today. So this could be an issue affecting more of the markets in the last couple of days, but specifically small caps today. Now, I think the bigger issue here really is in the rate market and why small caps have really been under pressure in 2025 so far. This article from CNBC says the Fed could be done cutting rates if Trump's tariffs are immediate, according to Bank of America. And yesterday, as some of you guys pointed out in the last video, the 10-year auction was awarded a 4.68% yield, the highest since 2007. And that is what helped hurt markets yesterday. You also have some pretty dramatic rises in global rates. Okay, it's not just the US, it's basically everywhere besides China, including the UK today, that seen their 10-year treasury yields go up 16 basis points today. And the 30-year treasury yields go up 17, almost 18 basis points today. I mean, that's a really bad day. In fact, our 10-year treasury yields are down 1 basis point to 4.673% today, but yesterday they rose over 7 basis points, so there has been a tailwind of higher rates in the last couple of weeks. And again, it's not just the US, it is Australia, it is Spain, it is Germany, it's France. Everywhere is seeing their yield rising. Whereas there is a free fall in China's government bonds, their 10-year treasury yields, if you will, from 2.2% recently, now down to 1.60%. That's a massive drop, as you can see from all of these red days in a row. So it does seem like there is some weird relationship going on here between China's yields falling, the rest of the world's yields rising. It could be kind of like a carry trade debacle where people are borrowing via, Chinese bonds and maybe buying the rest of the world's bonds, or vice versa. It's technically selling rest of the world's bonds and buying Chinese bonds, because when you buy the bonds, the bond yields come down. When you sell the bonds, the bond yields go up. So there's definitely a weird relationship going on there that I think is affecting the riskiest parts of the markets. That's why we have seen small caps and some of the more beaten down areas just continue to suck into 2025. I don't think that will last indefinitely, but at least for now, that seems to be the trend that we are on. Now, this was some of the big news as well today that really just is like an FU in the face to everything else that we've talked about here, broadly speaking, in markets today. It came from the Fed, specifically Chris Waller. And this post is from Nick Timmerhouse. Chris Waller says he expects inflation to continue declining to 2% and doesn't sound at all like someone ready to declare or even hint at an end to cuts. Key quote, Quote, "My bottom line message is that I believe more cuts will be appropriate. On the inflation forecast, Waller is optimistic because 6-month annualized inflation is heading lower. Core was at 2.4% in November, better than the 2.8% year-over-year rise. Most of the stickiness in inflation is coming from imputed prices, which is 1/3 of the core basket, and a, quote, less reliable guide to the supply-demand imbalances, and base effects, which could bring the year-over-year inflation rating down by March if the next few months don't pop back up." Waller says, quote, "Minimal further progress on 12-month inflation readings has led to calls to slower stop reducing the policy rate. However, I believe that inflation will continue to make progress towards our 2% goal over the medium term and that further reductions will be appropriate." Now, what's fascinating about this, as Andy Constan says on X, I've actually heard this a lot from Fed Waller's speech today. Let me just read this quote here. "The only thing to report from this speech is how desperate Chris is for Trump to give him the chair in 18 months. So everyone's just saying this is kind of trying to get on Trump's good side to become the next Jerome Powell, essentially. That is, of course, following news yesterday that Trump said that rates are far too high. U.S. Treasury Secretary Janet Yellen said today, "I hope the new administration will take the deficit seriously." It's like the kettle calling the kettle black. I mean, it's ridiculous. Janet Yellen is like, oh my gosh, I don't want to be too mean here, but this is like a bully getting mad at another bully for bullying someone. This is just ridiculous. And Janet Yellen says that spending on COVID may have contributed a little bit to inflation. I mean, that was all of the reason we had inflation for the most part. Inflation is only ever government spending. It's not greedy corporations. It's not people spending all of their money. It is government spending. It is robbing Peter to pay Paul. That is what inflation is. And of course, sometimes inflation is amplified when you rob Peter to pay Paul, but Peter didn't have shit to begin with. Then Paul tries to buy stuff from Peter and there's nothing to buy. There's one apple and then he's trying to buy 10. Then obviously you have inflation there, right? Meaning supply chain disruptions amplify inflationary effects, but it really comes from government spending, bottom line. And Treasury Secretary Janet Yellen says today that recent data suggests the path of interest rates may be higher than people expected. I mean, I don't know where she's been at, but this is kind of already known information. Now, James E. Thorne on X says China 30-year treasuries continue to drift lower with a yield of 1.854%. Deflation in the lost decade are real possibilities. This next part kind of threw me for a loop, though. He says, with overcapacity in manufacturing, it's only a matter of time before deflation reached the West. And let's hope that does not happen. Maybe a little bit of deflation would be okay. But if we were to see an actual spout of deflation that lasted a while, we would be up shit's creek way too fast. Everyone thinks their grocery bills falling would be good, or their energy prices falling would be good, or all of these other things, prices that is falling, would be positive. In fact, that would be a massive negative for economic activity. So be careful what you wish for in regards to deflation. And Fed Waller says today that long-term yields may have more of an inflation premium, but the Fed will fix that. And even Neil Dutta here said at the bottom of this post, he says there's a few things on his mind, talking about housing supply and mortgage demand that's crumbling, rates going higher again where the labor market continues to cool. Things that we kind of already know, that rates are rising in a global nature. It's not just the US, where China yields are falling. Kind of the same stuff that we've talked about here in this video. Now, this last post was interesting. He says, this morning, we saw Waller on the tapes. He was dovish in the sense that he sees still slowing inflation and additional rate cuts. He also said, quote, if, as I expect, tariffs do not have a significant or persistent effect on inflation, they are unlikely to affect my view of appropriate monetary policy. Again, sounds like someone wants to be Fed chair next year. And Fed Waller says, I will support further cuts in 2025, but the pace will depend on further inflation progress. And not a lot of people caught this, but yesterday the NASDAQ posted its single largest daily volume in history with 13.4 billion shares that traded hands yesterday. This beats the previous record of 11.9 billion shares on May 16th, 2024. Now, as far as Tesla stock today, you're currently up 0.65%, up to about $397 per share. Sentiment over on StockTwits today for Tesla is bearish at 44. Yesterday, it was bullish at 60. So a little bit more bearish today than yesterday. Message volume today is normal at 50 versus yesterday it was at 53. And participation ratio today is normal at 54. Option activity today in Tesla stock is pretty good. 69% positive order value as far as options today in Tesla. You have 84 different trades totaling $75.75 million. And you can actually see on the day today, you have about 515,000 shares that are being covered on today. So there is a net covering, and I think a lot of that had to do with Tesla that was in the red today. I think people are starting to take the opportunities when they get them to cover on their short positions in Tesla when Tesla is having these red days. Because after all, do you really want to be short on Tesla in 2025? Probably not. Again, there's 3 big risk factors to Tesla and our markets this year. Number 1 is more aggressive tariff policies than expected. We could get a 10%, maybe even 15% blanket tariff on everything, and the markets would probably rally on that. Okay? If we were to get like a 50% China tariff or something, markets would crash on that. That would end the bull market. That would be a big risk for stocks. Okay, and that's kind of discretionary in nature. If Trump wants to push that route, he can. So I think that's the biggest wild card for this year. So that's big risk number 1. I think our expectations are already pretty negative though. So I think there's a good chance that maybe the reality of the situation is not going to be as bad as maybe what our fears are currently. So that's number 1. Number 2 is inflation resurging again. I mean, as long as there is no supply constraints, as long as the port strike does not happen or is not super prolonged, and there's not this mismanagement of government spending, I'm not super concerned about inflation this year. But hey, I've been surprised before. And number 3 is a weakening economy. Now, a little bit of weakening is fine, but too much weakening causing recession fears, that would cause a crash for stocks. And that is the 3rd big risk catalyst for this year. On that note, today we did get the ADP employment change, which came in at 122,000 job ads. Expectations were around 140,000, so that missed expectations. Okay, Wall Street didn't seem to react too much to it, though. You would expect missing on a jobs report would cause Treasury yields to fall more than 1 basis point. But we really didn't react to it. The big jobs report is on Friday. Keep in mind, tomorrow markets are closed for trading, so that'll be important. We're kind of going to have a digestion period and then get slapped with the jobs report. So Friday's going to be a big green day or a big down day. That I can almost assure you. Now, initial jobless claims today came in at 201,000 versus expectations of 218,000. So continuing to surprise to the downside for initial jobless claims, which is interesting because this is the first, or captures part of the first week of January, which if we're going to see jobless claims start to rise, it's going to be here in January after the holiday shopping season is now over with. And ladies and gentlemen, Tesla stock is now up almost 1% on the day today. We will have a lot more to talk about in the next video, so stay tuned to the channel for that one, including a breakdown of Tesla's technicals, which look pretty good today. I mean, Tesla bounced right, literally spot on. Couldn't have happened any more perfect than it did. Bounced right at this trend line here. So we need to discuss that and a lot more in the next video, including the Fed minutes, which I think is really kind of a topic for a whole nother video, I would say so myself. So thank you guys for watching. Ladies and gentlemen, enjoy the rest of your day, and I will see you in the next one.